Absolutely. Speaking of the bond move, you've done a lot of work recently about the backup in bond yields, the sort of the changing, the evolution of the demand in the Treasury curve, and also this sort of shock that we've seen in the last few couple of months on term premium. What are your sort of kind of summary thoughts there? We can sort of unpack it as we go.
Well, I think the big picture thoughts is we moved basically from an unsustainable bond market situation where there was, massive government supply, huge money printing, and very low yields, to, I think, a bond market today that looks a lot more. I should also say, and there was relatively strong growth and high inflation, right? Like that's kind of where we were. If you roll the clock back 18 months, and that suite of conditions created, through time, a relatively significant up move in the bond yield, right? It wasn't that long ago when 10-year bonds were like below
We,
150.
yeah.
Um,
So,
and so, which, it's hard to believe, but is the reality, right?
yeah.
That is something that has happened before. I mean, just a few years ago. And I think basically, I think those folks who remain bearish on the bond market are like extrapolating that dynamic at a time when the market composition has radically changed, and it's radically changed because the price has changed. And so what's
Mhm.
happened is, it's true, the Fed has gone from buying to selling, right? And the government deficit, well, the government deficit was super high, but the government deficit was super high and will be less high in the future on the margin. But the big thing that's gone on is that all of those yield sensitive buyers have started to come in. And so I showed a chart on Twitter this morning, yield sensitive buyers, which is just households, ETFs, and mutual funds, which are household, direct and indirect purchases. They went from basically zero when bond yields were at, 150 basis points, to now buying $1.5 trillion of bonds today. Okay, well, that's a big difference, right? That's a big difference. $1.5 trillion annualized pace. That's
Totally.
basically enough to cover the bond issuance necessary for the deficit.
Mhm.
Okay, well, that's a radically different thing. And this is how bond cycles work, um which is that uh the cure, the modified version of the old classic tale, the cure for higher yields is higher yields, right? Like that is the cure, right? And it happens almost mechanically, that the cure for higher yields is that yield sensitive buyers come in. And you see that, like, even as TLT and price terms has sold off, right? The inflows into those ETFs have surged, because investors buy bonds on yield. They don't buy bonds on price, which is
Mhm.
smarter because yield is better representation of expected return. And
Totally.
so we're seeing that play out. Now we're kind of in a stasis here where, basically, like, we can reasonably explain why. It's reasonable to expect that at roughly these yields we'll be able to fill even relatively sizable deficits.